The Reserve Bank's inflation hawks are in hiding as fears about Europe and the US engulf world markets. The RBA board held interest rates steady as it acknowledged the uncertain global environment and kept its interest rates options open. At the same time, the Commonwealth Bank cut fixed-rate home mortgages as some funding costs continued to fall. Here's finance correspondent Philip Lasker.
Amid the market turmoil, the Reserve Bank Board fled to the mining capital of Perth to make its interest rate decision, perhaps seeking sanctuary from the global upheaval.
Well, there may be a little of that in it.
Certainly the turmoil was front of mind as the official cash rate was kept at 4.75% for a 10th straight month. In a statement, the board observed that the global outlook is less clear than it was a few months ago and that the near-term growth outlook for Australia looks somewhat weaker.
Well, it was a more sobering statement this time and more cautious, if you like, on the part of the Reserve Bank. The ebullient rhetoric that had been there about the global economy seems to have diminished considerably. And the bank was also acknowledging that there are headwinds in relation to the internal economy from the cautious consumer and also the high Australian dollar.
But the RBA also acknowledged inflation remained a threat and, in the eyes of some, that ruled out one course of action.
Right, the Reserve Bank is still concerned about the medium-term outlook for inflation, so you don't cut rates in that environment. And if things do settle down, if the global economy does stabilise, then I think rate rises come back on the agenda.
But some focused on what accompanied the concern about inflation, an acknowledgement that the global turmoil and a softer domestic economy may help keep a lid on prices.
And I think they're probably now leaving the door open for potential interest rate relief as we move forward.
Others don't see it because they can't see past Australia's trade performance.
Last financial year, our trade surplus improved by $25 billion. Now, that's a couple of percent of GDP. It tells you that the income flow generated by this terms of trade story is in fact hitting the Australian economy. And we know from the Reserve Bank thinks that about 60 cents of every dollar in that turnaround is going to stay in the domestic economy.
Australia's current account deficit narrowed significantly in the June quarter to $7.4 billion. The terms of trade rose more than 5% to record levels, but the trade performance will still be a drag on growth by 0.5%.
It's volumes that matter, and so prices did a lot of that improving as far as the trade position was concerned. Much higher export prices for coal, for example, but the volumes, they were up compared with the first quarter, which was very flood affected, but not particularly much.
And there were also signs of life in the latest housing finance figures.
It's starting to show some recovery off a low base.
Despite the rate rises that we have seen housing finance stabilise and in fact start to lift a little.
But it all seems insignificant in the face of what could go wrong in Europe and the US.